Hi guys, in this video I'm going to go over the U.S. Consumer Spending Report that came out today. This report is also known as the Personal Spending Report, and it comes out monthly, so the data we're looking at in this article is for May. According to this report, the personal consumption increased at a record 8.2% pace from the month before. That's certainly a good report, but we have to put it in the context of the past reports. So for that, I'm going to refer you back to the Trading Economics site to get that timeline. And you'll notice for May, we have 8.2%. Okay, but look what happened in the months preceding. We had in April a drop of 12.6%. And in March, we had a drop of 6.6%. And in February, we had no change. So this is clearly the recession taking hold as the COVID lockdowns stifled consumer spending. If people are locked down in their houses, they can't really spend. And on top of that, if businesses are shut down, as many were, consumers can't buy anything. So a lot of spending was relegated to online shopping at a limited number of retailers. Now go back even further. You'll notice that on a monthly basis, the changes are usually in a fraction of a percent. This goes back 1 year. Go back 5 years, okay? So it's very little change. Go back 10 years, very little change. Go back 25 years. This report actually goes all the way back to the 50s. And you'll notice that the changes on a monthly basis are relatively small. And then here we get COVID-19 lockdowns and the recession we're in now. And that's where the shocker comes, right? So that's what we're seeing here. Now, you might ask, well, why would we focus on consumer spending when there's other types of spending? For example, consumers buy things, but so do businesses, so does government, so does the foreign sector. There's a lot of spending in the U.S. economy, and only a portion of it is consumer spending. But understand that consumer spending is the biggest portion. It makes up over 70% of spending. So when consumers are spending a lot, it stimulates business activity. And when consumers are spending very little, it contracts business activity. In fact, consumer spending is so important. We'll see there's another report that comes out that measures the confidence level of consumers to see how optimistic they are about their future. When consumer confidence goes up, people spend more, stimulating business activity. When consumer confidence goes down, people spend less, curtailing business activity. Let's go down and look at a little more detail here. So this chart here shows personal income versus spending. And you'll notice going all the way back to 2015, personal income has grown, and then it really shot up. Here's February, and then it goes to March and April. Really shoots up. And then spending also went up. Well, that makes sense, right? Because if you have income going up, you would expect spending to go up. And that occurred up to this year. But look what happens in this year. You see income go up a lot. And I'll explain why in a minute. But income goes up a lot from February to April. But spending drops from February to April. Well, the increase in income came not from people's jobs. I mean, let's face it, people have been losing jobs. It came from government stimulus. A lot of people received a check from the federal government, about $1,200 for an individual and $2,400 for a married couple. And so that's the spike in income. But because as the government was sending out these checks for people to use, people couldn't use them, right? They stopped spending, again, because of the lockdowns and the limited amount of businesses that were open. So let me show you another chart here to kind of illustrate this. This chart here shows what's called the personal savings rate. Savings is the other side of spending. So for example, this number here shows that in March, 12.6% of income was saved. In April, 32.2% of income was saved. in May, 23.2% of income was saved. So that's how we interpret this particular metric. And what do we know from the prior graph? We know that in March, personal spending dropped, and in April, personal spending dropped. What would we expect to happen to savings? If personal spending is dropping in both these months, shouldn't we see the savings rate go up? And that's what you see, March and April. Savings rates go up. And then in May, we see personal spending go up by 8.2%, so an increase. Well, what would you expect to happen to the savings rate? You'd expect it to go down. And that's what happens. It goes from 32% in April to 23% in May. So people were saving less and spending more. You can also see this change in the article. You'll notice that this chart breaks down savings, which is the orange line, and you can see that savings really spiked here back in January. We were at 1.3 trillion in savings. These are actual dollar values rather than percentages of income, as we saw in the other illustration. And then it goes all the way up to 6 trillion by April. Okay. And then it shows the consumption in its three subcomponents. Consumption can be broken down into services and then non-durable goods and durable goods. So essentially goods and services. Non-durable goods are goods that do not last more than 3 years. Durable goods last more than 3 years. And then services are where you're essentially buying an intangible. Someone's time is a service. You go to the dentist and get your teeth worked on, or you go and get your hair cut, or you go and see a movie. You're not getting anything tangible. You're getting a service. Services are a big part of consumption, and notice that services really took a big hit here in the beginning of the year. Okay, but you can see the spike, right? Savings goes up, and then for the most part, each of the subcategories goes down, with services getting hit the most. In addition to sending out those stimulus checks to Americans, our nation's central bank, the Federal Reserve, also got involved. And what they did is they lowered the interest rates to almost zero. Now, how would this affect the economy? Well, if you lower interest rates, it makes the cost of borrowing lower. So people are going to borrow more money and buy more homes, they're going to buy more cars, they're going to buy more furniture, they're going to buy a lot of other things. A good portion of people's spending is based on access to credit, and access to credit is going to be influenced by interest rates. So by using the variety of monetary policies, the Federal Reserve has been able to push interest rates down and to try to stimulate people spending more. Now, think of it like this. When the federal government issued those stimulus checks, they were implementing what's called fiscal policy to try to help the economy in this dire time. When the Federal Reserve lowers interest rates, they're implementing what's known as monetary policy to try to help us out of these dire times. It's like having two doctors address an ailment that is causing you pain. Both of them come together to create, hopefully, a combined outcome that wouldn't be possible if only one policy was implemented. So let's wrap up with where we're at and where we're headed. The May report tells us that after a couple months of decreased spending, we've seen an increase in May. And that coincides with an easing of the lockdowns across the country. It makes sense. As we return to normalcy, we would expect people to spend more, and that would stimulate business activity and hopefully bring about a recovery from this recession. However, we don't know how long the lockdowns will last because there's uncertainty about the virus. If there's an uptick in cases or death rates or both, then we may see further restrictions reinstated. And in that case, we could see consumption drop again, and we could see the recession it lasts much longer. Also keep in mind that there's still many industries that, despite opening back up, are not getting the business they used to. The travel industry, for example. Domestic travel is available now, but very few people are traveling. Another thing to keep in mind is people's habits have changed. Going out to a restaurant may have been a weekly thing for the average family, but because of the lockdowns, they may not have that habit anymore. They may not want to wait in line to get a seat in a place where social distancing limits the number of patrons. They may also find that it's more expensive now to shop, as these regulations have made it more difficult for firms to provide the same service at the lower prices. So there's a lot of hurdles ahead of us that we have to be aware of. But at this point, the uptick in consumer spending is a positive indicator for the economy, and we will just have to continue to watch what happens in the coming months, along with the other indicators, to get a sense of the health of the economy. All right, that's it. If you have questions, please let me know. Thanks.